Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture. Leases, IFRS 16. The objective is to establish the principles for the recognition, measurement, presentation, and disclosure of leases, with the objective of ensuring that lessees and lessors provide relevant information that faithfully represents those transactions. So, IFRS 16, which is leases, is a new standard. It is supposed to replace IAS 17. Under IAS 17, leases are categorized into financing and operating. Now, the existence of operating lease means that significant amounts of leases were held off the balance sheet. So, with the introduction of IFRS 16, all leases are now brought on the statement of financial position, with the exception of leases with a lease term of 12 months or less and containing no purchase options. And secondly, leases where the underlying asset has a low value when new, such as personal computers or small items of office furniture. Now, this selection also can be made on a lease-by-lease basis. So the accounting treatment for the low value or short-term leases is done through expensing the rental through profit or loss on a straight line basis. So let's test our understanding. Ricky Ben leases out a machine to Dennis under a 4-year lease, and Dennis elects to apply the low value exemption. The terms of the lease are that the annual lease rentals are $2,000 payable in arrears, that is at the end of the year. Now we have to explain how Dennis would account for the lease in the financial statement. So as a solution, on the statement of profit or loss, Dennis will recognize a lease expense for year 1, $2,000. Now under the statement of financial position for year 1, there will be a current liability for $2,000, which is supposed to be the lease payment for year 2. It will be up in a year's time. That is why it's under the current liabilities. Then under non-current liabilities, it will recognize the lease payment for the rest of the 2 years because it's going to be due beyond a year. So when it comes to year 2, the same 2,000 will be recognized. The lease payment attributed to year 3 will be recorded under current liability. And the one for year 4 will be under non-current liability. When we move to year 3, you recognize the lease payment for year 3. Come to statement of financial position. Recognize the lease payment for year 4 under current liability. Now, there are no lease payment which is due beyond a year's time. So there's no non-current liability here. So when you move to year 4, when you recognize the lease payment, there will be nothing to be recorded in the statement of financial position. Let's now delve deep into what a lease is. A contract is or contains a lease if a supplier, known as a lessor, transfers the right to control the use of an identified asset to a customer, known as a lessee, for a period of time, which is called a lease term, in exchange for a consideration which is supposed to go to the lessor. Now, control exists when the customer or the lessee has the right to direct the identified or the underlying asset's usage and to obtain substantially all the economic benefits that would arise from the use of the asset. Now, where a supplier has the substantive right of substituting the underlying asset throughout the period of use and benefits economically from doing so, means that the customer doesn't have control, at least them. Now, this is the non-cancelable period for which the lessee has the right to use an identifying asset. Now, a capacity portion of an asset is still an identified asset if it is physically distinct. Example would be the floor of a building, which is separated from the building, or the set of furniture which is found in the office space. Now, a capacity or other portion of an asset that is not physically distinct. So, example would be a portion of a fiber optic cable. It's not an identified asset unless it holds the capacity necessary for the customer to derive all economic benefits. Now, an identifying asset or an underlying asset is normally explicitly stated in the contract. That will tell you what the asset, the lease, is shrouded around. On the other hand, the underlying asset may be implicitly stated at the time when the contract is being signed or the item is being passed on to the customer. Let's now move on to discuss separating components of a contract. Now, a lease in the contract is separate from other leases if both of the following criteria are met. The lessee can benefit from the use of the underlying asset either on its own or together with other resources that are readily available to the lessee. And secondly, the underlying assets neither highly depend on or is highly interrelated with the other underlying asset in a contract. So for a contract that contains a lease component, an additional lease or non-lease component, such as the lease of an asset and the provision of a maintenance service, utilities, etc., each lease and non-lease component in a contract should be accounted for separately. However, as a practical expedient, a lessee may elect by class of an underlying asset not to separate non-lease component from the lease component and instead account for all of the component as a lease. The consideration shall be allocated based on the relative stand-alone prices if they are available. It should be estimated if observable prices are not readily available. Okay, so lessors shall allocate consideration in accordance with IFRS 15, that is revenue from contract with customers. We move on to discuss accounting by lessee. We first look at the initial recognition. Okay, now at the lease commencement, a lessee recognizes a right of use asset and a lease liability. The right of use is initially measured at the amount of a lease liability plus any initial direct costs incurred by the lessee. Now, adjustments may also be required for lease incentives. So, lease incentive is normally a payment from the lessor to a lessee for no job done. So, something like a payment to entice the lessee to take up the asset, payments on or prior to commencement date, and estimated cost for dismantling. Lease liability, on the other hand, is the present value of the lease payment payable over the lease term, discounted at the rate implicit in the lease, if that can be readily determined. Now, if that rate cannot be readily determined, the lessee shall use their incremental borrowing rate. So, interest rate implicit in the lease is the rate that yields the present value for 1, the lease payments, and 2, the unguaranteed residual value equal to the sum of the fair value of the underlying asset and the initial direct cost of the lessor. Incremental borrowing rate, on the other hand, is the rate of interest that a lessee would have to borrow over a similar term with a similar security, the funds necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment. Lease liability. It is made up of fixed payment, which is all payments that are not variable. In substance, fixed payment. Now, these are payments whose form appears to contain some variability, although they are in substance unavoidable. So this can occur where payments are structured as variable, but there is no genuine variability in those payments. Okay. Secondly, there is more than one set of payment options described in the lease, but only one set of those payments is realistic. Or there are more than one realistic set of payments described in the lease, but the lease must select at least one of those set of payments. Okay. So the example will be that when you strike an agreement with somebody and you say that the person is supposed to pay you a certain amount if he or she has no business, and will pay you another amount if he contracts a business. Now, when you look at the situation surrounding the person's trade, if there is no way the person can live within the specified period without engaging him or herself, then the other option automatically becomes the choice. So it is variable, either A or B, but in practice, there is no way the A will be applicable. The third component of lease liability is a variable payment. Now, these are payments linked to a consumer price index or a benchmark interest rate, such as a LIBOR, or payment that vary to reflect changes in market rental rate. Okay, so variable lease payments that are not included in the initial measurement of the lease liability are recognized in the profit or loss account in the period in which the event or condition that triggers it occurs. So unless the costs are included in the carrying amount of another asset and another standard. The fourth component is a residual value guarantee. Is the value of the asset after the lease term for which the lessee is reasonably expected to acquire the asset for. The last component is a penalty for termination when it is reasonably certain that it is going to occur. Subsequently, we recognize right of use asset at cost less accumulated depreciation and impairment. So it can be done under 3 models. The first is the cost model. So under the cost model, the right of use asset is measured at cost less accumulated depreciation and accumulated impairment. Or when it is recognized under the revaluation model, it is revalued and subsequently depreciated or adjusted for impairment. And lastly, when the asset is treated as an investment property under IAS 40, then the fair value of the asset will always have to be sought for. The subsequent recognition for a lease liability is that a financial liability at amortized cost is what is supposed to take place. So the lease liability will subsequently be remeasured to reflect the changes in the lease term. That is, if a revised discount rate is used. The assessment of a purchase option using a revised discount rate. Amount expected to be payable under residual value guarantee. Future lease payments resulting from a change in an index or rate used to determine those payments using an unchanged discount rate. Okay. Now the rate measurements are treated as adjustment to the right of use asset. So lease modification may also prompt remeasurement of this liability unless they are treated as separate leases. Let's test our understanding. On 1st July 2015, Ben entered into a 5-year lease of a machinery. The machinery has a useful life of 6 years. The annual lease payments are $5,000 per annum, where the first payment made on 1st January 2015 means it was made in advance, not in arrears. Now, to obtain the lease, Ben incurs initial cost of $1,000 in relation to the agreement of the lease, but the lessor agrees to reimburse Ben $500 towards the cost of the lease. The rate implicit in the lease is 5%. The present value of the minimum lease payment is $22,730. Now we have to demonstrate how the lease will be accounted for in the financial statement over the 5-year period. So when we come to the solution, we recognize the right of use assets of $23,230, which the workings will be shown soon. Then there will be a cash negating the asset column of $500. It's a combination of the initial cost of $1,000 and the incentive of $500 because it was given to entice Ben to take up the facility. Then we have a lease liability of $22,730, so the effect is going to be the same. So when we come to the workings, the right of use asset includes the lease payment, as said earlier, of $22,730. Okay, that's the present value of all the lease payments till now. The initial cost of $1,000 is added. The lease incentive, the $500, is reduced from the calculation, leading to $23,230. So when you record the right of use asset, the initial cost, the double entry will be to debit the right of use and credit cash. Okay, so there will be a cash reduction of $1,000. The incentive will be to credit right of use and debit cash. So when we knock off the debit recording against the initial cost of $1,000, there will be a deficit of still $500. So subsequently, the right of use asset is going to be depreciated over the lease term, which is 5 years, which is going to give $4,646. Now this is going to be charged annually to the profit or loss account. Also, when we come to the liability, we are going to treat it as a finance liability. We are going to treat it to the amortization schedule. So for year 1, we bring the lease liability here, which is $22,730. And the payment, because it was done on 1st January 2015 in advance, we bring it here. If it was done in arrears, we'll bring the interest before we take out the payment. So that's $5,000, leading to a capital balance of $17,000. Then we charge the finance cost, which is the 5% on it, leading to $887. It will lead to a balancing figure of $18,617, which is supposed to go to the non-current liability portion of the statement of financial position. The finance cost of $887 will also go to the profit or loss account. When we bring the balancing figure for year 1 to year 2, it will be an opening. We take out the same $5,000, lead to a balance of $13,617. We charge a finance cost of $681. It will lead to an amount of $14,298. We bring it to year 3 as an opening. We take out the payment of $5,000, a capital balance of $9,298. Charge the interest on it, $465. It will result in a balance of $9,763. We bring it to year 4 as an opening. Take out the payment of $5,000, leading to a capital balance of $4,763. Charge the finance income on top, then it will give $5,000. So realize that when we bring it to year 5 as an opening, when we pay out the $5,000, nothing will be left outstanding. So all the finance income is going to go to the statement of profit or loss in addition to the depreciation. Let's quickly move to accounting by lessor. So the lessor shall classify each lease as a finance lease or an operating lease. Lease is classified as a finance lease if the lease transfers ownership of the asset to the lessee by the end of the lease term. The lessee has the option to purchase the asset at a price which is expected to be sufficiently lower than the fair value at the date the option becomes exercisable. That at the inception of the lease, it is reasonably certain that the option will be exercised. Thirdly, the lease term is for the major part of the economic life of the asset, even if the title is not transferred at the inception of the lease. So the present value of the minimum lease payment amounts to at least substantially all of the fair value of the lease asset. And lastly, the leased asset is of a specialized nature such that only the lessee can use them without major modification being made. So any lease that fails this test will be classified as an operating lease. So upon the lease commencement, a lessor shall recognize assets held under a finance lease as a receivable at an amount equal to the net investment in the lease. So a lessor recognizes the finance income over the lease term of a finance lease based on the pattern reflecting a constant periodic rate of return on the investment. A lessor recognizing operating lease payment as income on a straight line basis or in a pattern that is representative of the payment schedule. So fellas, that is all we have to discuss on leases. I've been able to explain everything to bring it to your understanding. However, if there's anything that requires our attention or clarification, do not hesitate to put them in the comment section below. Also that, kindly click on the subscribe button, hit the notification bell by it, like and share. So we'll come to you again by way of tutorials on the go. Take care of yourself and stay blessed. Puka, puka.